There's a post on Reddit right now that should make every American with a retirement account stop what they're doing. A woman just discovered that her mother put $60,000 into a John Hancock conservative retirement fund back in 2014. 12 years later, that account is worth $39,000. Her mother didn't lose that money in a stock market crash. She didn't withdraw it. She didn't do anything wrong. She just trusted the word conservative on the label, and the fund quietly bled $21,000 of her retirement savings. Today, we're going to break down exactly how this happens, why it's far more common than you think, and what you need to do right now to make sure the same thing isn't happening to your money. Because here's the thing, this isn't a John Hancock problem. This is an industry-wide problem. And millions of Americans are sitting in funds just like this one, watching their retirement quietly disappear, and they have absolutely no idea. Let's start with what actually happened to this woman's mother's money. She put in $60,000. 12 years passed. The account is now worth $39,000. That means she didn't just earn zero. She actually lost money in nominal terms. And when you account for inflation, which has averaged around 4% over this period, the real loss is even more devastating. In today's purchasing power, $60,000 from 2014 is worth closer to $96,000. So in real terms, she's down $57,000. Now compare that to what happened to the S&P 500 over the same period. If you had put that same $60,000 into a basic S&P 500 index fund in 2014, you wouldn't have $60,000 today. You wouldn't even have $96,000. You'd have somewhere between $160,000 and $180,000, depending on dividends and reinvestment, potentially more. The difference between this safe choice and the boring index fund? $140,000. That's not a rounding error. That's the difference between retiring comfortably and working until you physically can't anymore. So how does a fund that calls itself conservative manage to lose money over 12 years? The answer is fees. And they are absolutely brutal. Here's what most people don't understand about investment fees. They're not a flat dollar amount you pay once a year. They're a percentage of your total assets, charged every single year, whether the fund goes up or goes down. And they compound in reverse. Every dollar you pay in fees is a dollar that can't grow for the next 20 years. Conservative funds from insurance-backed companies like John Hancock, Transamerica, and Principal Financial often carry expense ratios between 1 and 2% per year. That sounds tiny. It isn't. Vanguard's total stock market index fund charges 3 basis points. That's 0.03%. That's not 3%. That's 0.03%. Fidelity offers several funds with zero expense ratio at all. So when you're in a John Hancock conservative fund at 1.2%, you're paying 40 times more in fees than you would in a comparable Vanguard fund. For what? For worse performance. Let's run the actual math on what fees do to your retirement over time. Say you start with $100,000. Assume a 7% average annual return before fees, roughly what a diversified stock portfolio has historically returned over long periods. With zero fees, after 30 years you have $432,000. With 1% fees, after 30 years you have $324,000. You've paid over $100,000 in fees. With 2% fees, you end up with $243,000. Nearly $200,000 has gone to fund managers instead of to you. And remember, those fees come out whether the fund makes money or not. In years where the market drops, you're still paying. You're paying to lose money. Now, to be fair, there are legitimate reasons conservative funds exist. If you're 75 years old and you need stable income, you genuinely don't want all of your money in the stock market. The issue isn't conservative investing. The issue is high-fee conservative investing that underperforms even its own risk-adjusted benchmarks. What the John Hancock Fund in the Reddit post was supposedly doing was protecting capital. But it didn't protect capital. It destroyed it. Over 12 years, in a period when nearly every asset class, stocks, bonds, real estate, even gold, posted positive returns, this fund lost money in absolute terms. This raises a question a lot of people ask. Why don't financial advisors tell their clients about this? The answer is uncomfortable. Many financial advisors, particularly those tied to insurance companies or large banks, are not fiduciaries. A fiduciary is legally required to act in your best interest. A non-fiduciary advisor is only required to recommend something suitable. Suitable and optimal are very different standards. If a fund pays the advisor a commission, it's suitable to recommend it, even if there's a dramatically better option with lower fees. This is how people end up in high-fee products they don't need. AI image, magnifying glass over fine print of investment contract. So what should you actually do if you think this is happening to your money? Step 1. Find your expense ratio right now. Log into your 401k or IRA account. Look for the funds you're in. Find the expense ratio. If it's above 0.5%, you need to understand why. If it's above 1%, alarm bells should be ringing. Step 2. Check your actual 10-year returns versus the S&P 500. Your brokerage will show you your account performance. Compare it to a simple S&P 500 benchmark over the same period. If you're dramatically underperforming over a decade, fees and fund selection are almost certainly the culprit. Step 3. Look for index fund alternatives inside your plan. Most 401k plans are required to offer at least a few low-cost index funds alongside the high-fee options. Look for anything with index in the name, or specifically look for S&P 500 or total market funds. Even inside a bad 401k plan, there's usually at least one reasonable option. The average American in their late 50s has about $240,000 saved for retirement. It sounds like a lot until you realize the general guideline is to have 10 to 12 times your annual salary saved by retirement age. For a household earning $75,000 a year, that means you need between $750,000 and $900,000. $240,000 is not enough. And if even a portion of your savings has been sitting in a high-fee fund that's quietly underperforming for a decade, the gap gets even wider. Now here's the thing that makes this story particularly infuriating. This isn't complicated. The fix isn't complicated. Low-cost index funds have been widely available since the 1970s. John Bogle at Vanguard was saying all of this 50 years ago. The academic research is overwhelming. Over any 10-year period, low-cost index funds outperform the vast majority of actively managed funds. This is not a controversial claim in finance academia. It's one of the most replicated findings in the entire field. And yet, millions of Americans are still in high-fee funds. The reason is distribution. Insurance companies and banks have enormous sales networks. They employ advisors who earn commissions on the products they sell. And the products with the highest commissions are almost always the products with the highest fees. The math works out perfectly for everyone except the investor. AI image. Two paths diverging in a road leading to different outcomes. Let me tell you about one more thing that makes this situation worse than it already sounds. When you're in a high-fee fund, you don't just lose the fee money. You lose the compound growth that money would have generated. Every dollar that goes to a fund manager at age 40 is not just $1 lost. It's potentially $4 or $5 lost by retirement, because that dollar could have been compounding for 25 years. Economists call this the fee drag effect, and it's why a 1% fee doesn't cost you 1% of your retirement. It can cost you 20, 30, even 40% of your final balance over a long enough period. Here's another thing worth understanding. Conservative doesn't have to mean low return. There are legitimate conservative investment strategies that protect your principal while still outperforming inflation. Short-term bond index funds, Treasury inflation-protected securities, known as TIPS, and high-yield savings accounts all offer genuine capital protection without the fee bloat of actively managed conservative funds. If someone genuinely needs to be in a conservative allocation, they can do it cheaply. A 2-fund or 3-fund portfolio of low-cost index funds, even one weighted heavily toward bonds, will almost always outperform a high-fee, conservative product from an insurance company over any meaningful time period. The fund in question wasn't just conservative. It was expensive and underperforming on its own stated terms. That's not a trade-off. That's just bad. What should the woman in the Reddit post do now? First, don't panic sell. If the fund is inside a 401k or IRA, she can move to a better fund inside the same account without triggering taxes. This is called a fund transfer or rebalance, and it's completely free in most plans. Second, look at what the current balance can become. $39,000 invested in a low-cost index fund for 10 years at a 7% average annual return becomes about $77,000. The damage is real, but not irreversible. time in the market. Even starting from a depleted balance still compounds. Third, if the account is with an insurance company and there are surrender charges or exit fees, calculate them carefully before moving. Some annuity products charge early withdrawal penalties. Know the cost before acting. So what's the bottom line? If your mother, your father, your spouse, or you yourself has money in any retirement fund with an expense ratio above 0.5%, today is the day you look into it. Not next week. Today. Log into the account. Check the funds. Compare them to a total market or S&P 500 index fund. Calculate what the fee difference compounds to over 20 or 30 years. Then decide if the fund you're in is earning its cost. In most cases, it isn't. In most cases, there is a better option sitting right next to it in the same plan menu, charging 1/40th of the fees with better long-term returns. The story of that $60,000 fund that became $39,000 is a tragedy, but it's also a completely preventable one if you know what to look for. And now you do. If this video helped you understand what to look for in your own retirement accounts, subscribe. We break down exactly this kind of thing every single week. And if you know someone who might be in a situation like this, share it with them. It might be worth a lot more than they expect. This video is for educational and informational purposes only and does not constitute financial advice. Please consult a licensed financial professional before making any changes to your investment accounts.